Hi everyone, we got bank Q2 profits down. We have inflation taking its toll. We got the Bank of Canada looking to take center stage again on June 7th. We're going to talk a little bit about where rates are going. And fixed rates are making a move. So we're going to cover all this, your questions. We're going to go in the grab bag and we'll get to it. It's episode 132 of the Wise Old Owl Show. For those of you that still haven't subscribed to my YouTube channel, please do so at owlmortgage.ca. I'd really appreciate it. We are really going to get into this interest rate situation today. So a lot of the banks reported this week their quarterly profits. A number of them were down year over year. You had Scotia, RBC, BMO lower than normal, which is causing some concern, right? We are seeing that their cost of funds is being dramatically impacted, and it's putting pressure on interest rates. Just to give folks an understanding of where we are, just a few weeks ago, 3 weeks ago, on May 20, I guess, 3 weeks ago, so that will be May 4th, we had the 5-year Canada bond rate at 2.88%. Okay, and we were seeing rates move down a little bit. Since then, it's jumped up to 310, 333 last week, and this week it's sitting, as of about 3:30 this afternoon, at 3.515. So we're seeing a steady increase to the 5-year bond, and over a 3-week period, that is a 63 basis point increase. Now, does it have a lot to do with the U.S. Fed and dealing with that debt ceiling issue? It could, but here's my theory. Ever since rates have started going up, the significant amount of money that was sitting in bank accounts at Canadian banks was earning zero. So rates were going up over the last year, and people started shifting their bank account balances into GICs. And that put a lot of strain on the cost of funds for a lot of these banks lending out money. So what does that mean when you have an inverted yield curve as we do? So to just simplify things, when we have a regular curve, we have lower rates for lower terms, higher rates for longer terms. So when you think of a 1 year being at 3% and a 5-year being at 5%, a bank can make money lending out money when the majority of mortgages are 5-year terms. When the interest rate curve is inverted, as it is right now, short-term rates are higher than long-term rates. So when you have people getting paid almost 5% on a 1-year GIC, and you have 5-year terms at 4.5%, you could see how banks can't make money doing that. It'll be very, very difficult. So it's a real interesting scenario, and we're starting to see some signs of credit tightening. We're seeing a lot of lenders really have difficulty getting mortgages approved because the stress test and the qualifying rate is putting a lot of pressure on people. Now, I'll give you an example. We're starting to see a little bit more listings come about, and that would mean good things for the market. But when pre-approvals are starting to come in the door at a more rapid pace, their borrowing power goes down because the qualifying rate is hampering their ability to borrow. So we're at this really interesting stage where we're starting to see more listings, we're starting to see a little bit more activity, but people are having a harder time qualifying for mortgages. And we're seeing that in the office on a regular basis in the last few weeks. The stress test is really putting some pressure on people. We had a case this week, someone did sell, they're going out to buy, and they want to buy at a certain price point, but they can't qualify on the A side for this amount. Now they have a pre-approval, and it was set at, I think, 4.8% on a 5-year, which is a really good rate. It's not available anymore. So they're saying, well, Vince, can't you go to another lender? And I said, no, I can't, because if I go to another lender, the qualifying rate is now higher. So you qualify for less. So it's a really strange time, and I'm really interested to see how things are going to play out. But one thing is certain, we're starting to see things break. We're starting to see, the 3 stages of this situation filter through. We're already through the first stage where people are starting to budget, starting to clamp down. We're starting to see folks really take an interest in their household discretionary spending by cutting it. A couple stats that came out recently for Canadian Tire and Leon's Furniture. And I use Canadian Tire and Leon's because they're not retailers that really sell necessities, okay? These are retailers that sell stuff that for the most part, you could live without it if you really, backyard stuff and, extra furniture and TVs. You don't necessarily need that. You kind of go with what you got if you really don't have the cash flow to do it. So those 2 retailers are seeing their sales plummet, okay? Their retail numbers are down. So we're starting to see that first stage of tightening. The discretionary spending is causing a challenge on the retail side. We're starting to see it filter through. Business insolvencies are up dramatically. And the volume of liability in those, the volume of dollars of those liabilities, of those insolvencies are up 800%, folks. So we're starting to see things break. The second phase is going to be the credit cards. People are starting to use them more, balances are going up, and people are starting to pay for necessities with credit, okay, because they've depleted their savings. And it's now causing another pressure point. And then the last would be mortgage payments. People will always tighten their belt first, get onto the credit card merry-go-round, and then deal with their mortgage as a last resort. So we're starting to see some challenges in that regard. Really interesting. Now, what I want to point out is we are slowly going to approach peak renewal pain, okay? And this is probably going to be a term we're going to use a little bit more often over the next little while, especially over the second half of this year. So just to kind of bring everybody up to speed, we know there's a lot of folks that are starting to renew their mortgages at significantly higher rates than what they were paying, okay? And right now, at this point, about 33 to 35% of people have renewed their mortgages so far. If you take or seen an increase to their mortgage payment, okay, 33 to 35%. And if you back out all the fixed variable clients, fixed payment variable clients, that drops to 29%, okay? So we still have about 65% of mortgage holders that haven't seen their payment go up relative to what we've seen with the interest rate market. So 2/3 of home buyers haven't seen the pain yet. Now here's the interesting thing. Till the end of this year, the renewals that are coming up this year to December 31st, we're going to hit 47% of those mortgage holders. And by the end of 2024, we're going to see a 65% of those people feeling that increase in mortgage payments. So over the next 18 months, we're going to see 30% of mortgage holders go through a restructuring of their mortgage payment, which in most cases is going to go up, okay? Unless the lender are your parents and they're not going to charge you anything, or a family member. So almost 1/3 of all mortgage holders over the next 18 months is going to see their payments go up. And what does that mean for the economy? It's going to impact discretionary spending. Inflation continues to ramp up. We're not seeing any breaks at the pumps, at the grocery stores. As a matter of fact, as I talked about a lot of these multinationals like Procter & Gamble, Unilever, Nestle, Pepsi, these are multinationals that have thousands of SKUs, which means these are products that sit on grocery store shelves. Their volumes are going down and they're increasing prices to make up for the revenue loss. So that means grocery prices are going to continue to go up. We're seeing shrinkflation, for example. Prices may not go up on a bag of chips, but there's less chips in the bag now, or less cereal in a carton or whatever the case is. We're seeing that shrinkflation on a regular basis. So it's costing us more, and it's going to impact discretionary spending. But there is opportunity. There is opportunity because real estate continues to be unbalanced. We're seeing housing starts tumble. We're seeing building permits slow, and population immigration continue to surge. So people need to live somewhere. And this is where the opportunity presents itself in the form of investment properties and rental properties. So if you have the ability to look at buying real estate and converting it or repurposing or whatever the case may be, that is probably going to be your best bet right now. And this is what we're doing on a regular basis. We're helping people out. We're putting them in touch with great trades that focus on these type of properties. And we're seeing property rental income surge because there's just not enough units out there. And the premium rental prices are going to new product, brand new, to that take into account the code, building code, properly built. You know, they got to be inspected by the city and all that, and it's getting some really good rents. So really, really interesting to see how the legislation in the city of Toronto of upzoning is going to impact real estate in the core. And whether or not 905 follows, I'm not sure, but there probably is going to be some pressure of the surrounding municipalities to follow the City of Toronto's mandate in that regard. So really interesting time. Let's talk about people tightening the belt. Let's go to the the used Porsche Tracker. For those of you that don't know, every week I post a number, and it's the number of used Porsches for sale on Auto Trader that are 100 kilometers away from where I sit here at Owl Mortgage at Dufferin and Orphis. Okay, I started doing it last September when the number was at 944, and over the last few weeks it's gone up quite a bit. Okay, so 2 weeks ago we were at about 1,054. Last week we're at 1,124, and this week, as of this afternoon, we hit 1,145 used Porsches for sale, 100 kilometers away from where I sit, or stand, actually. That's 21.3%. Now, you know, I get a lot of DMs saying, Vince, you know, it's the summertime, this is when people want to buy Porsches and this and that. But there's also the other side of people wanting to get rid of them. And the question is, why do they want to get rid of them? It's too expensive, costly, the payments may be too high, maybe need some cash, need to free up some capital to do other things. People are restructuring, rebudgeting, reprioritizing what is more important. And it's really, really interesting to see this data point be impacted as much as it has as rates have gone up. So really interesting. We got a question here. If I want to buy an Airbnb, does the lender look at qualifications differently? A lot of lenders don't want to lend on Airbnb properties. You know, they'll do searches, and if properties are listed on Airbnb, they kind of shy away from them. You're going to have to go into the private alternative space market for that. People, traditional lenders don't want to deal with Airbnb because of the transient nature of the rental income. You know, it's tough to gauge. They're very profitable. But if you really want to do Airbnb, it's very capital intensive and you're not going to get traditional rates. Now, if you're converting a traditional home into an Airbnb where the financing's already in place, it's not a big deal. But when you're buying an Airbnb property, there are lenders that will do searches on that property on Airbnb and see if it's listed. And if it is, they're going to designate it as property non grata. They don't want to deal with it, and you got to go to an alternative private lender. We've done quite a few of them. Especially in cottage country, where you have some private lenders that really are keen on that. Mind you, they're going to want a little bit more downstroke on the purchase if you are buying. And some have even helped on the construction side converting it and wanting to see it being properly managed by a property manager of sorts. So thank you for that question. So I'm going to go into the grab bag, the hockey helmet, for a question. And I'm really not going to pull one out because the amount of questions I've gotten are very similar to the one that IOMAG25 just asked. What's happening on June 7th? What is the Bank of Canada going to do with rates? It's been the most common question that I've been getting daily, if not hourly, by clients, industry people, colleagues, peers, lenders. They're all asking what's going on. And here's my take on it. I think the Bank of Canada is going to hold on the rate for the June 7th meeting. And I think it's because there's not enough data that is telling them otherwise. The inflation report that came out for April, although it was higher than expected, economists called for 4.1, it came in at 4.4, right? And higher than March, so it went the wrong way. It was only 1 month, and it was close enough for the Bank of Canada to say, well, we still don't know what May's number is going to show, and that's going to come out mid-June. So the May inflation number will tell the tale of where the Bank of Canada is going to go. I think they're going to hold right now. We're starting to see some things break, and I believe they're just going to hold. Now, I could be wrong, right? The prediction business sucks and makes a lot of people look like fools. And especially when you're taping these things and you post them and people could go back on them and say, hey, you said this and blah, 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 blah. That's my opinion. I think they're going to hold. Looking at the data, I think Tiff is in a tough situation. And if you really let the market play out the way it should, we probably would be in a worse situation right now. Okay, I think there'd be a lot of people in difficult situations if lenders hit all those trigger rates and reset people's payments where they should be. I think that not pushing people to the stress test limit that they were qualified at will be a big mistake. And listen, it's put people in a lot of comfortable situations, just staying stand pat, not doing anything, and letting them just ride it out and having these infinity type amortizations. But in the long run, you're literally renting your property. You're not building any equity and hoping that values go up if you have a quality property. So it's an interesting time, but I'm going to say rates are going to hold for the most part on June 7th. And then in July, we're going to see what the Bank of Canada is really going to do. I think that's going to be the big meeting to set the stage. And folks, I don't think rates will be coming down anytime soon unless there's a major event which could be triggered from something that happens in the States or elsewhere. So, we'll see what happens. Lubmika, what percentage of private lenders lend right now for residential? Just wondering. Well, the majority are. I think they're just being more selective. I think what's happening in the private space is that there's a liquidity problem. So, a lot of lenders are saying, okay, I only got so much available to lend. I want quality property, quality situations. I'm not going to take bigger risks than I need to. So those deals on the margins are having a hell of a tough time to be placed because lenders are being very selective. And the reason for that is there's not a lot of payouts. A lot of folks in private mortgages haven't been able to rehabilitate. They haven't been able to move to the alternative space. They haven't been able to refinance. There's either not enough equity, there's not enough qualification income to get into that Alt A, which has to be qualifiable income. And it's creating problems for this segment. A lot of private money is sitting in existing portfolios that aren't turning over, and that's causing a problem. So, we're seeing privates say, I want better quality clients. I want to pick and choose where I want to put my money. And if you're on the fringes, this is where we're starting to see people being pushed out into a situation where they're being forced to sell, okay? And we've had to have some conversations with folks to say, hey, maybe that's your best choice. Unfortunately, you don't have any other option. And you shouldn't be going from a private to a private. Like if you're going from a private to a private, you're not listening to good advice, okay? Any broker that pushes you from private to private is not doing you any favors because the costs are excessive. You're going to have additional lender fees, additional broker fees, appraisal fees, legal fees. At the end of the day, everybody's going to eat away at your equity and you lose. So if you're in that situation and you can't get help from a family member or friend, you're best to just sell and try to recapture as much or protect as much equity as you possibly can and avoid going into an, excuse me, another private. Okay, so thank you very much for that question. I think there's another question in here. I gotta see how to access this, but just bear with me. Is it bad to buy new homes right now? Well, there's still lineups. You know, I was doing a show with Nick Opadesano on Tuesday. There's still lineups at certain new home development sites, which is really surprising. But I will tell you this. The condo market seems to have stalled. And you know, we talked a lot about this in January and February. There was 32,000 new condos being delivered in 2023. 19,000 of them were going to be in the first half of 2023. So we're coming almost to the end of the first half. A lot of product is sitting. We're seeing a lot of people struggling to close these units because they don't have the cash flow, right? The carrying costs associated with a lot of these condos to rent them out is negative. So they're seeing $1,200 to $1,500 negative cash flow, and it's putting a lot of strain on people trying to get into that investment property market for the first time, especially the newbies. When you're looking at $1,200 to $1,500 shortfall, that's $18,000 a year that you're going to have to come up with after tax to carry that rental because the rents don't cover. And sadly, the majority of these units are mostly one bedroom plus den. So you're not really in a unique market where you could differentiate yourself. So we're seeing a lot of these things for sale, especially in the assignment market. It's pretty much dead. So if you are looking to get into that market, you may be in a good position to get a good deal, okay? And we're seeing some folks even taking a haircut because they don't even want to close. They want to get rid of it before they have to close because they don't want to go through the alternative financing, the private financing that's quite costly when they know they're going to flip it and try to sell it. So there may be a good opportunity in that assignment market to find some deals if you are looking to get in. Not sure if anybody has any other questions or not, but hold on, did I miss one? I live at Yonge and Shepherd. The listed house prices are out of this world. When will this stop? Well, that's a good question. It's a very good question. I don't know. You know, the city of Toronto passed legislation to upzone homes in the Yellow Belt. And the Yellow Belt pretty much means everywhere in the city. So these are folks that have now gotten the ability or have the ability to increase their single family home up to 4 units, plus a garden suite or a laneway suite if it's permissible. So all of a sudden, the ROI on low-rise property just went up. So it's going to be in higher demand. And unfortunately, the folks that have a lot of cash and capital and access to credit are going to be in the driver's seat here, because they're going to be the ones probably buying up whatever comes available. And it's going to create a more difficult situation for people wanting to get into that space. But it's very clear that if you want to get into the market, the condo market could be the opportunity. Of course, it's a different type of living, different type of dynamics, and there's no ability to improve on that property. When you buy a condo for 600 square feet, it's 600 square feet. Like, you can't grow it. You can't put a second floor. The only thing you could do is put bunk beds in and hammocks to increase the number of people living in there. And that's if your condo corp doesn't have any limits on how many people could reside in a property. I don't know if that even exists or not. But when you buy a low rise, you can improve on it, right? If you have a semi, you could put a basement apartment in. You could possibly put a garden suite or a laneway suite. You know, we're seeing some projects on a regular basis where people are buying single family, converting them to 4 units. And it's common downtown. Just drive around, you'll see it happening more and more. And this is where opportunities present themselves, and this is maybe how people have to rethink how they get into the market. Maybe they have to stretch a little bit, live in the basement for a while, rent out the main unit, look at ways to help them afford homes. And this is what we're doing on a daily basis in our office with our clients. So if you do need help in this regard, please reach out. Any realtor out there looking for a hand? We got people ready to buy. I need folks that want to sell. Let me know. I'll be happy to help out. And we're here to serve. We got a great team. And if you need any assistance, any help, please drop me a DM, and I'd be happy to help out. And thank you to all the folks that have reached out via email, DM, on Twitter. I really appreciate it. We're really eager to give you guys top-notch service and help you out with white gloves and give you the skinny on all the opportunities out there, because there's many. Here's a question from Cushstream. If immigration is surging and we don't have enough homes to meet demand, and the government of Canada predicts 580,000 people coming to Canada this year, where are they all going to go? Good question. We're a four-season country, so they're not going to be camping in the wintertime. They will most likely have to live in basements. I think the city's upzoning legislation will help a little bit. I just don't think it's going to be fast enough. But there's a disconnect. Keep in mind that of the population growth that comes into this country, 60% of it is non-permanent. Okay, so they're here on a work permit or a student visa, and chances are, if the economy goes to shit, okay, these people will leave and go somewhere else. Okay, they won't necessarily stay. We've seen that happen in the past when recessions have hit. So once the jobs go, people leave if they're not permanent residents. Okay, so I wouldn't be too worried about that yet. Okay. Here's another question. If you do buy a new construction property today, should you ensure there is an option for an assignment sale? How can a buyer be protected in case rates increase when it's time to close? Most builders do offer assignment clauses at a cost. Some in the past have just not offered it, but there is an assignment cost that you'd have to pay for them to allow you to do that. In the condo market, there's a fixed price traditionally that's charged, but find out what that assignment fee is, negotiate it up front. You do have a 10-day cooling off period, I believe, in the city of Toronto, in Ontario, so take advantage of it. Have your lawyer look at these things and make sure you're fully covered. But thank you for that question. We're coming up to half an hour here, and I'm gonna wrap it up. But I want to thank all of you for tuning in. I have an event to go to. That's why I'm all dressed up in a monkey suit. Rarely do you see me in a shirt and tie. But I'm heading downtown for an event. Really excited. Got invited to it. Should be great. But what I will say is, it's getting tougher. We're seeing tougher situations. I want everybody to be kind to people. If you have the ability to buy somebody dinner, buy them lunch, buy a drink, a coffee, do so, show some kindness. There's a lot of people struggling that won't talk about it. And if you could just make their day, it will make you all better people.